The global gold market enters the second quarter facing severe technical and fundamental economic shifts. Following a historic climb earlier this year, the precious metal experienced rapid downward price corrections. Market experts warn that structural risks are accumulating rapidly across multiple trading platforms and exchanges. Analysts note that the recent recovery above $4,700 might deceive investors. This upward movement could merely represent a temporary corrective rebound within a broader market downtrend. The market exhibits clear signs of momentum exhaustion that threaten critical underlying support levels today. Technical specialists identified specific scenarios, projecting much deeper declines for the precious metal very soon. One highly dangerous path involves prices encountering temporary resistance before continuing their aggressive downward descent. If resistance levels break temporarily, buyers might mistakenly believe the overall market adjustment has concluded. Such an upward movement toward $5,200 creates a massive bull trap. Retail investors purchasing at these elevated levels would face significant losses when prices reverse downward. Analysts predict a subsequent aggressive decline targeting the $3,800 support zone. This bearish target represents a substantial 20% decrease from current elevated spot market valuations. Reaching this lower threshold would effectively return gold to fair value zones established last year. Intraday technical structures further reinforce these growing bearish concerns among professional commodity traders and institutions. The current price action resembles a bearish flag pattern highlighting severe momentum exhaustion and weakness. Indicators show breakdowns from ascending trend lines, despite the precious metal making several local price highs. Moving average convergence-divergence readings indicate the recent corrective rebound is rapidly losing its upward steam. A definitive drop below $4,500 could trigger sudden bearish selling sequences. This downward momentum would expose intermediate support levels near $4,319. Prices could ultimately fall toward the pivotal 200-day exponential moving average support line. Geopolitical instability traditionally drives safe haven demand, but current conflicts introduce highly complex systemic risks. The ongoing military campaign against Iranian nuclear infrastructure creates historic disruptions across global energy markets. Restricted maritime passages have removed massive amounts of crude oil from the daily global supply. Energy market shocks pushed crude prices toward $120 per barrel this week. European natural gas prices also experienced massive spikes, exceeding 40% during this chaotic period. While gold normally benefits during such crises, it has surprisingly behaved like a speculative risk asset. Presidential addresses signaling continued military strikes without clear timelines initially caused gold prices to spike. However, the precious metal quickly reversed lower as traders prioritized liquidity amid rising economic uncertainty. Markets are now pricing the negative economic impacts of an energy-driven global growth shock. The bearish $3,800 target remains deeply rooted in supply-driven stagflation. Historical data shows gold often underperforms during periods characterized by extreme energy supply chain disruptions. Rising energy costs trigger sharp drawdowns across equity markets, forcing institutions to liquidate valuable assets. Institutional investors often sell liquid assets like gold to cover massive portfolio margin call requirements. Energy-driven inflation raises widespread expectations for tighter monetary policy from major central banking authorities. Rising bond yields increase the overall opportunity cost associated with holding non-yielding precious metals. The United States dollar frequently acts as the primary safe haven during global energy crises. America is perceived as more energy independent compared to many European and Asian trading partners. A rising dollar index creates direct headwinds for bullion prices across international commodity exchange markets. The structural bull market earlier this year relied heavily upon anticipated interest rate reduction narratives. This positive narrative encountered significant resistance from persistent inflation and hawkish central bank policy adjustments. The Federal Reserve recently delivered a hawkish hold citing persistent oil-driven consumer price inflation. Central bankers reduced projected rate cuts for the current year from 2 down to 1. This fundamental monetary policy shift completely broke the thesis that initially supported gold's massive rally. Signaling higher interest rates for longer durations pushes real treasury yields substantially higher across markets. Gold typically maintains a strong negative correlation with real interest rates during normal economic cycles. The current environment of rising yields remains fundamentally bearish for the precious metal going forward. Market expectations for rate cuts are now pushed further into the second half this year. If the energy shock proves more inflationary than recessionary officials may avoid cutting rates entirely. Such hawkish monetary inaction would likely accelerate a rapid downward move toward extreme support levels. Another significant headwind involves the potential unraveling of the previously dominant global de-dollarization trade. Aggressive central bank gold buying was previously justified by nations shifting away from American currency. Recent reports suggest major geopolitical players might return to using dollars for international trade settlements. This pivotal currency shift carries massive structural implications for the global physical gold market valuation. If reserve diversification is no longer the primary driver, the narrative premium could quickly evaporate. Market participants increasingly view gold as a crowded momentum position vulnerable to incredibly fast unwinding. Institutional forecasts for the current year highlight extreme spreads between bullish and bearish market scenarios. While major banks maintain bullish year-end targets, they have significantly raised their downside risks. Leading institutions warn about potential severe liquidation, events dragging prices toward lower baseline support levels. Prolonged supply chain disruptions and equity market weakness could easily trigger systemic global financial deleveraging. Conversely, some highly optimistic banking institutions argue that the current correction remains completely normal today. They believe strong central bank purchasing activity will provide an unbreakable floor for commodity markets. However, even bullish analysts acknowledge the recent unprecedented price ascent was completely unsustainable over time. Gold trading more than 30% above moving averages requires a very meaningful valuation reset. Institutional modeling suggests returning to a bullish trend remains probable over a 12-month horizon. However, the tail risk of a deeper immediate correction stands at its absolute highest point. The base case scenario involves prices consolidating while markets await clear resolutions to regional conflicts. Stabilizing real yields and continued institutional buying on price dips could support this neutral outcome. A rapid military de-escalation might push the precious metal back toward higher resistance zones. The bearish case involves a liquidation event triggered by systemic banking or severe energy crises. Such events would force movements below critical moving averages toward $3,800. The primary counter-argument against this extreme bearish scenario remains sustained historic central bank demand. Official sector buying previously accounted for nearly 18% of total global precious metal demand. Emerging market central banks continue functioning as the dominant buyers supporting physical market price floors. Various nations have steadily increased their strategic reserves to hedge against ongoing global economic instability. However, mechanical limits exist regarding how much physical gold these central banking institutions can purchase. As valuations rise, official buyers need fewer physical tons to maintain their target reserve percentages. Projected annual demand shows a notable decline from the extreme peak levels seen recently globally. Reduced physical tonnage demand could remove crucial support necessary to prevent a massive technical breakdown. Accelerated speculative selling from exchange-traded funds would easily overwhelm any remaining central bank purchasing. Western retail and institutional demand through these public funds has historically been highly volatile lately. Recent institutional additions are largely considered tactical rather than long-term structural portfolio allocation strategies. This tactical demand remains closely tied to hedging against fiscal deficits and central bank independence. The risk of aggressive downward targeting magnifies if these public fund holders suddenly liquidate positions. Restrictive real interest rates make the carrying cost of holding gold funds incredibly burdensome today. Sustained high federal funds rates could trigger mass market exits similar to previous historical cycles. Inter-market dynamics reveal high correlations between gold and other major global financial asset classes. While spot gold faces technical risks, the mining equity sector presents a completely divergent picture. Select mining stocks have potentially bottomed, forming constructive bases for future market outperformance over time. Selective bottoming characterizes late-stage corrections, where robust producers attract capital despite falling metal prices. Broader mining indices remain under severe pressure, reflecting general risk-off sentiment across global markets. If gold drops toward $3,800, mining stocks face final sharp sell-offs. Durable market bottoms would only form after these aggressive capitulation events conclude across mining sectors. Silver shows notable divergence from gold, indicating deteriorating outlooks for global industrial growth and manufacturing. The white metal faces heavy pressure from its industrial component amid the ongoing energy crisis. Analysts closely watch key technical necklines, but downside risks skew heavily toward lower support levels. Meanwhile, crude oil remains in a structural uptrend, supported by severe shipping disruptions and conflicts. The medium-term energy trend stays bullish as long as prices hold above critical supports. This divergence, where oil rises while gold falls, highlights the unique nature of current shocks. Analysts frequently compare current market structures to historical peaks preceding long-term bearish consolidation phases. The current environment bears striking similarities to extreme valuations reached over a decade ago today. Past market cycles driven by fiscal concerns ultimately resulted in massive multi-year price corrections. History suggests the impending correction might initiate a prolonged period of stagnant precious metal valuations. However, previous energy shocks provide a slightly more bullish precedent for the current global conflict. Historical embargoes and revolutions caused massive percentage gains for both crude oil and physical gold. The crucial difference today involves gold entering this conflict already trading at absolute record valuations. Overvaluation makes the precious metal significantly more susceptible to sharp 20% downward price corrections. The fundamental path toward lower technical targets remains supported by robust macroeconomic and technical conditions. While long-term structural cases remain intact, immediate risks dominate the short-term trading landscape. Deceptive technical paths combined with systemic pressure from energy-driven liquidations threaten current price stability. Critical market milestones approaching soon will determine whether bullish flags invalidate these aggressive bearish patterns. A daily market close below critical moving averages confirms the end of the current bull. This confirmation opens the door directly toward the highly anticipated 3,800 target. Further conflict escalations would likely accelerate the liquidation scenario as traders dump risky precious metals. Investors must prepare for significant ongoing volatility and potentially deceptive temporary rallies that ultimately fail. Gold currently behaves more like a speculative risk asset than a traditional safe haven investment. Lower price targets represent necessary reset points, where fundamental value can finally retake market control. The complex interplay between hawkish monetary stances and inflation shocks will define future market directions. Unraveling global narratives regarding currency dominance strongly influences whether severe corrections materialize later this year. Professional market participants recognize that conventional valuation metrics currently face unprecedented challenges and systemic disruptions. Forecasting precious metal markets requires comprehensive scenario modeling incorporating variables across macroeconomic and geopolitical dimensions. Participants must evaluate probability-weighted outcomes rather than relying blindly upon single-point price predictions. Extreme volatility experienced recently demands sophisticated assessment methodologies, extending far beyond traditional fundamental market analysis. Technical indicators suggest the metal remains elevated relative to carefully calculated fundamental fair value metrics. Current pricing shows significant premiums above models incorporating monetary base relationships and historical price correlations. Derivatives market activity reached exceptional levels, demonstrating massive sustained institutional participation across diverse trading strategies. Economic indicators suggest deceleration across developed economies, creating conditions that typically support precious metal demand. However, strong employment data could support higher interest rates, increasing opportunity costs for gold holdings. Restored confidence in traditional financial markets might significantly reduce safe haven demand across global exchanges. Central banking policies remain the primary fundamental driver for precious metal valuations and market stability. Monetary accommodation directly impacts currency purchasing power, alongside crucial real interest rate calculation metrics globally. Interconnected global banking creates massive spillover effects, amplifying policy impacts across all international financial markets. Current federal funds rates maintain restrictive monetary policy environments relative to historical market baseline norms. Real interest rate calculations become critical because negative rates historically correlate with strong gold performance. If inflation expectations stabilize, while nominal rates decline, real rates approach positive territory, limiting upside. International central bank policy coordination has deteriorated as regional economic conditions diverge substantially across continents. European accommodation timelines differ significantly from American expectations, creating substantial volatility across currency exchange markets. Emerging market banks face distinct inflation challenges, prompting continued reserve accumulation despite elevated purchase prices. Geopolitical analysis requires careful assessment regarding conflict escalation probabilities and their impact upon investor demand. Current global tensions span multiple regions involving major economic powers, creating elevated baseline risk premiums. Regional conflicts present sensitive situations highly capable of generating swift precious metal price increases unexpectedly. International trade policy uncertainty creates additional layers of geopolitical risk, supporting defensive asset allocation strategies. Tariff implementation timelines generate economic uncertainty that historically correlates with massive currency volatility increases worldwide. Supply chain disruptions from trade conflicts exceed immediate tariff impacts, creating broader global economic uncertainty. Government fiscal sustainability metrics across developed economies suggest elevated risks regarding future sovereign debt concerns. Bond market stress indicators show increasing sensitivity to fiscal policy announcements from major political leaders. Historical flight to quality patterns demonstrate the crucial role gold plays during major debt crises. Technical analysis frameworks provide essential guidance for position management during periods experiencing extraordinary market volatility. Price level identification helps investors optimize entry timing while managing risk exposure effectively across portfolios. The massive psychological barrier around $5,000 represents significant resistance based on options positioning. Support level identification becomes crucial because precious metal markets frequently experience rapid, unexpected technical corrections. Fair value calculations provide fundamental anchoring points for assessing potential downside support during market panics. Current estimates place fair value significantly below recent trading levels, indicating substantial downside price risks. Expected trading range calculations suggest future volatility may moderate compared to recent exceptional market swings. Mathematical analysis indicates potential range compression based on historical patterns and current institutional market positioning. Implied volatility trends provide forward-looking expectations, helping establish appropriate position sizing parameters for traders. Industrial consumption patterns represent secondary but highly meaningful price support mechanisms for physical gold markets. Technology sector advancements generate consistent demand, providing pricing floors during periods of global economic expansion. Semiconductor industry requirements continue expanding as artificial intelligence applications proliferate across multiple vital economic sectors. Jewelry demand represents approximately half of total consumption, making consumer discretionary spending patterns absolutely critical. Emerging market wealth accumulation continues supporting jewelry demand growth despite periodic economic volatility and uncertainty. Cultural demand factors provide relatively stable consumption patterns, persisting through various complex global economic cycles. Global mining industry analysis reveals multiple structural constraints supporting higher pricing through fundamental supply limitations. Production capacity limits and cost inflation pressures create natural supply restriction mechanisms, benefiting price formation. Geological depletion at existing mines constrains expansion potential, while new project development requires many years. Environmental regulation compliance costs continue increasing across all major mining jurisdictions, impacting future global supply. Permitting timeline extensions add substantial development costs, raising minimum viable project economic thresholds for producers. Ore quality deterioration represents the most significant long-term challenge facing precious metal mining operations. Average ore grades declined substantially over recent decades, requiring increased processing volumes to maintain output. Processing cost inflation pressures compound grade decline impacts, demanding more energy per ounce of product. Mining jurisdiction stability ratings reveal concentrated production exposure to regions with elevated political risk profiles. Strategic portfolio positioning requires comprehensive scenario planning incorporating multiple potential outcomes with risk-adjusted optimization. Precious metal allocation strategies must balance upside participation potential against necessary downside protection portfolio needs. Rebalancing trigger points help maintain target allocations while capturing profit-taking opportunities during extreme movements. Systematic tracking approaches prevent emotional overreaction to individual data points while ensuring awareness of developments. Employment report impact assessment requires analysis of headline unemployment rates and underlying labor market strength. Inflation measurement interpretation becomes increasingly complex, as traditional metrics may ignore currency debasement impacts entirely. Investor positioning surveys provide valuable insights regarding speculative momentum that indicates potential major trend reversals. Extreme positioning levels frequently precede significant price movements in completely opposite directions, trapping retail traders. Options flow analysis reveals institutional sentiment, providing advance warning of massive upcoming portfolio allocation changes.